Chapter 11 of the Financial Playbook for Gen Z. Let's jump right in. Chapter 11, monitor your credit report and your credit score. Monitor your credit report and your credit score. This is very important. Being intentional and strategic about building and maintaining an excellent credit score is important because excellent credit provides great advantages, including low interest rates, and higher rates of approval for cards, like credit cards and mortgages and loans, right? The two most important factors in building an excellent credit score are paying your bills on time and keeping your overall credit utilization under 10%. Now, let's talk about your credit score, right? Now, what is a credit score? So basically, it's a number that represents how reliable you are in paying back money you've borrowed. The higher your score, the more a company or lender can trust that you will pay them back in full and on time. Plus, having a high score means you receive more benefits, such as higher borrowing limits, right? Higher credit limits. The higher the score, the lower your interest rates will be when you borrow money, right? But that's not all. There are many other benefits to having a high personal credit score, such as lower insurance costs. Did you know that by having a high personal credit score, you can get more options for renting apartments even, right? Oftentimes, landlords check your credit report and credit score when deciding whether or not to rent to you, right? A better credit score can also open you up for more job opportunities. Did you know that many jobs check your credit report and credit score when analyzing whether they want to extend a job offer to you, right? You'll also have more opportunities to leverage good debt, right? When you become more sophisticated with investing, a high personal credit score will allow you to borrow money at a low interest rate and invest in assets that pay a much higher return on investment. That's called leverage. Oftentimes, this includes passive income streams, such as real estate. Your credit score is based on your credit reports. And what is a credit report? It's a financial report card that indicates how reliable you are in paying back debt based on your financial history. Many different credit scoring models exist, but one of the most popular credit scoring models is called FICO, right? And even within the FICO model, there are many different versions of FICO. Now, in general, the FICO scoring model is based on these 5 things: payment history, which makes up 35% of your FICO score; credit utilization, which makes up 30% of your FICO score; credit age, which makes up 15% of your FICO score; credit inquiries, which makes up 10% of your FICO score; and variation of credit, which also makes up 10% of your FICO credit score. Now, together, these factors comprise the score that informs people of your reliability with borrowing. The largest contributor to your score, making up 35%, is your history of paying bills on time. The second largest contributor is credit utilization, making up 30% of your score. This is the percentage that you're using of the credit that you have available, both on an individual level, like within each line of credit, and also based on the total amount of credit that you have available. So it's essential to keep that usage percentage low, right? Definitely keep it under 10%, right? Ideally, keep it under 3%. Right? One of the worst things you can do for your credit is to spend the maximum allotted amount on a card. right? You don't want to max out a credit card. Never max out a credit card, right? Credit age makes up 15% of your score. Now, what is the average amount of time you've had credit available to you? That's what credit age is about, right? The maximum, it's the average amount of time that you've had credit lines open, right? So I'm encouraging all the young adults to open up lines of credit in order to build that credit age early, right? Because when you're young, time is on your side, right? So you want to start early to build your credit age, right? Now, new credit inquiries contribute to 10% of your FICO credit score. Every time you apply for a line of credit, the creditor will inquire about your score. And this is considered a hard inquiry and will stay on your credit report for a fixed amount of time, right? Though it will likely bring your score down slightly, credit inquiries are a necessary step in the process of acquiring more credits. Now, my advice is to avoid opening up new credit accounts right before you plan to make a big financial move, such as buying a house or buying a car or applying for loans, right? Since your score will likely drop with the inquiry. But now, as a side note, when you're shopping around for a mortgage, right, you have a window of time in which you can apply to different mortgage companies, and all of those credit inquiries will count as one inquiry. So there are, different nuances to this. But in general, though, be very mindful of like hard pulls on your credits, right? Now, the final 10% is based on your credit mix, right? So credit mix is like the different types of credit that you have, like installment loans as well as revolving lines of credit, right? Now, revolving credit includes credit cards where you pay down a monthly balance and then can charge more, right? So the process continues in a cycle of accruing a balance and paying it off, right? Accruing a balance and paying it off. All right, so that's called revolving credits. Now, installment in credit is more like mortgages and car loans, where you pay off debt in installments or chunks, right? Now, as you can see, the two most significant categories are payment history and credit utilization. So although you want to be mindful of all five, right, factors, you should pay extra close attention to these two things: paying your bills on time and keeping your credit utilization low, right? Because those two things, right, your payment history and your credit utilization, those two things comprise 65% of your score, right? Now, monitor your credit report and your credit score on a routine basis. There are many ways to do this, starting with annualcreditreport.com. Annualcreditreport.com is the only website that is officially endorsed by the federal government to provide you a free copy of your credit reports, right? You can get one from each of the three major credit bureaus: Experian, Equifax, and TransUnion. Now, the standard rule is that you can get a free copy from each of those three major credit bureaus once per year. However, since COVID, right, since the COVID pandemic, they allowed you to get free copies of your credit report once per week, right? So I don't know how long that's going to continue, but that is what they've been doing. So you can get a free copy, once per week, So definitely get a free copy. Definitely get free copies of your credit reports, right? So that you can monitor that, right? Now, there are several types of credit monitoring services. Some are free and some are paid. Like, for example, a very popular free one is called CreditWise by Capital One, right? It's a free service that anyone, not just Capital One members, can take advantage of. Experian also has a free credit monitoring service. They offer paid services as well as free services. So take advantage of Experian's free credit monitoring service, right? Now, Credit Karma and Credit Sesame are other free services that you want to look into. Now, remember the three major personal credit reporting agencies: Experian, Equifax, and TransUnion. Between the three agencies, there is a variety of scoring models that they may use. For example, CreditWise, Credit Karma, and Credit Sesame use the Vantage score, right? When you apply for a mortgage, lenders look at your FICO score, which is slightly different from your Vantage score, right? So this accounts for the occasional differences that you might see between your FICO score and your Vantage scores, right? But realistically, they should be around the same number, like same ballpark number, right? Now, why is it important to monitor your scores? Well, by monitoring your scores on a routine basis, right, you can identify ways to improve your credit score, and you can strategize to prepare for future financial moves. For example, you might notice that your credit utilization is high, right? To fix this, you can strategize ways to keep your credit utilization low and improve your score. By consistently monitoring your credit report and your credit scores, you can quickly identify errors on your credit report, including fraudulent charges, right? It's important to spot these quickly so that you can dispute them as soon as possible. Now, responsible use of credit cards is one of the most effective ways to build your credits, right? However, if you've never opened a line of credit, you may find that you do not qualify for a regular credit card. In this case, you can start by getting a secured credit card, right? After several months of responsible use of a secured credit card, you will be able to qualify for a regular credit card. With a secured credit card, you secure the line of credit by giving the bank money in advance, right? Now, I'm very passionate about generational wealth. I'm passionate not only about building wealth for myself, but also helping friends and family build wealth. There are a few strategies to help your loved ones take a hold of their finances and build wealth for themselves. Consider helping friends and family build their credit score by adding them as authorized users on one of your credit cards. Your credit card account and its payment history will appear on their credit report, helping to boost their score, assuming that your own score is good, right? And that will help them piggyback on your good credit history and your good credit score, right? It's a great strategy. And there are a few caveats to keep in mind, though, right? Number one, most credit card companies have a minimum age requirement for authorized users, right? Though it varies, right? So you want to research that. This will be important to research prior to registering someone as an authorized user. Some credit card companies will allow an authorized user as young as 13 years old, right? While other companies may not allow users until they are at least 16 years old. Some companies may allow users to be added at 16, but their personal credit scores will not begin being affected until they turn 18, right? So there's different rules. You know, the rules differ vastly between credit card companies. And so it is important for you to thoroughly research prior to adding an authorized user to your credit card. Be sure to choose a credit card that reports authorized user status to all three of the major credit bureaus: Experian, Equifax, and TransUnion. The purpose of having authorized users on your credit card is to help them build their credit. But without reporting to the credit bureaus, their credit score will be unaffected, right? So even when adding an authorized user, you don't necessarily need. Oh, so here's a big point too. Even when adding an authorized user, you don't necessarily need to add them to, I mean, you don't necessarily need to give them an actual physical card, right? Solely being an authorized user will still benefit their accounts and score, right? It's an amazing way to build generational wealth and pass on lessons in financial education to younger generations in order to increase financial literacy across the board, right? In doing this, we lift others up. Chapter summary. To build an excellent credit score, always pay your bills on time and always keep your credit utilization under 10%, right? There's other factors, but those two key things are the most important factors, right? Action item, print out your credit report from www.annualcreditreport.com. Also, look up your credit score, right? Discussion question. What did you learn about your credit report and your credit score? Quiz. How do you build and maintain an excellent credit score?